Hello everyone, my name is Nathan Corroy and I'm joined by Dan Brown from Richardson Capital Management, and we're here today with the Economic and Investment Update for the month of April 2023. Dan, why don't we start with just a real brief recap of what we saw in the financial markets for the month of April performance-wise. Despite the fact that we had some pretty significant data points come out this month, which we'll talk about, we had a fairly muted month in terms of performance in the markets.
Yeah, Nathan. So both for stocks and bonds, fairly largely unchanged for the month, which is interesting because if we look back the last 6 months or so, all those months have been fairly volatile, and this is the first month in a while where we haven't had a big change. And if we look at, one of the catalysts maybe that help stocks, we could focus on earnings, for example. Mm-hmm. So to end the month of April, earnings season, we were about halfway through that earnings season, and the results were fairly positive. So results came in a little bit better than expectations, so that kind of helped stocks. We still think that, broadly looking at earnings expectations for the full year 2023, that they're still way too high. So we think that in future quarters, those earnings expectations are going to trend lower.
And Dan, in terms of fixed income, obviously a key focal point for the markets has been the Fed funds rate and the path of rate increases that the Fed has taken over the past year or so. We've got another Fed meeting coming up the first week of May. What are we expecting to see there, and what are our thoughts on kind of the rest of the year?
Yeah, so we think the Fed's going to raise interest rates another quarter point at that early May meeting, and that would mean that Fed funds would settle out at about 5.25%. So a pretty drastic move higher over the past year or so. And then we also think the Fed's going to signal that they want to pause there for a while. We think they've done enough work on the interest rate side that they can pause. And our takeaway from just listening to different Fed officials is they want to remain there for the rest of the year, with the intent being staying higher for longer on interest rates with the goal of continuing to drive inflation down. So we still notice there's a little bit of a disconnect between what the markets are expecting, meaning a cut later in the year, versus what the Fed wants to do. And we would say for now, pretty much believe what the Fed is saying, because the last year or so, that has been the best course of action.
And Dan, one of the more significant pieces of data we got in the month of April was the release of the first quarter GDP results, which came in at a positive growth rate of 1.1% annualized, which, although it was positive, was quite a bit below consensus estimates, closer to maybe 2%. Do you want to talk a little bit about maybe what was underneath that read, beyond just the headline number?
Sure. So first of all, we were tracking that number throughout the quarter, and the thing that we noticed is that number as early as January was fairly high. It was close to signaling like a 3% type of annualized growth rate. And when it was all said and done, as you mentioned, it came in at only 1.1%. So somewhat disappointing on that front. And looking at the underlying components, we see that consumer spending was still fairly strong. We wouldn't be surprised if that ticks lower in the future quarters. But the one concerning point was business investment. Business investment ticked quite a bit lower, so we take that as kind of a negative signal for future growth. And we wouldn't be surprised if we saw a second quarter or third quarter reading on GDP that actually was negative. So again, something that we've been prepared for a while.
Despite that positive GDP print for the first quarter of 2023, the key risk on the minds of a lot of investors is if and when are we headed to a recession at some point?
Sure, Nathan. So on a monthly basis, we have an investment committee meeting with all the advisors, and at that meeting, we review a number of economic data points, one of them being the leading economic indicators, which is something that's published on a monthly basis. It's comprised of 10 indicators, things like building permits, credit spreads, direction of stocks, etc. And what that is signaling is that we are very close to a recession. So again, we wouldn't be surprised if we do enter a recession here with negative economic growth for the next quarter or two. So the graph that we're showing is how that data point has trended, basically going back to 1965. And you can see it has a pretty good, reliable, consistent hit rate of signaling the start of a recession. So again, we think we're close to that point. And what it means for the stock market and the portfolios is, we already incurred a pretty drastic sell-off in the stock market last year in 2022.
Right.
So we saw the stock market was down anywhere from 18 to 30%. We don't think that's going to be in the cards because a lot of that was already discounted last year.
Right.
So we've had a pretty strong quarter or two of advances in the stock market. So we wouldn't be surprised if we had another sell-off. Just don't think it's going to be the magnitude of what we saw last year.
So Dan, given what we're seeing on the GDP front and on some of those economic indicators that we track, it's seemed prudent from our perspective to maybe de-risk the portfolios that we're managing a little bit. Do you want to give a little bit more detail on kind of what we're doing on that front and what the outlook looks like going forward?
Sure, Nathan. So we communicated in mid-April that we thought it was prudent to de-risk the portfolios. We had seen 2 consecutive quarters of fairly strong advances in the stock market, and we still think there's some risk out there that's really not priced into the market yet as far as an outcome of a recession, which we wouldn't be surprised if we saw that over the next 2 quarters or so. So we de-risked the portfolios by taking approximately 2 to 3% allocation out of stocks, depending on the strategy. And for the most part, that money was reallocated to fixed income mutual funds and money markets funds, which we think are very attractive. So coming out of a very low interest rate environment for the past number of years, we're now seeing we can earn 4.5, 4.6% in a money market fund, and even higher in fixed income mutual funds. So again, we wouldn't be surprised if a modest, mild recession was in the cards, but don't think it's going to be anything like a 2008 type recession.
Got it. And with that, we'd like to thank you all for watching. We certainly hope you find value in these videos, and if so, please feel free to share them with others. And as always, we thank you for your continued support.